Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. To close out last week, the market showed signs that we could potentially be nearing a turning point. Despite a lower than expected inflation report, the market couldn't hold on to any of the gains that it had on Friday. Opening higher but closing lower is usually a sign of market tops or bearish behavior. However, investors should be aware that there are lots of other opportunities out there besides the top performers, which are likely to be the stocks that are hit the hardest if this is the end. Some stocks have outperformed the S&P 500 over the past decade, but are still trading at discounts today. Some stocks that have tons of brand value are still being heavily discounted because the world is experiencing a slowdown. Others are temporarily out of favor due to high interest rates and other sector-related headwinds. The point is, we have lots of stocks out there that, if purchased today, would deliver a generous return over the next 5 to 10 years. These stocks are still trading well off of their all-time highs, but not because the company is deteriorating at its core. These stocks will rise again, and when they do, I want in on the action. Let's talk about 3 stocks in particular that are down in the present but are highly likely to recover in the future. First on the list is Diageo. That's ticker symbol DEO. This stock is down 12% year to date and 24% over the past year. These numbers would make me stray away from most stocks, but for a company like this, we could be looking at an opportunity of a lifetime. Diageo is a high-end provider of alcoholic beverages under Johnnie Walker, Baileys, Guinness, Ciroc, Smirnoff, Crown Royal, Don Julio, Casamigos, Captain Morgan, and more. Needless to say, their brand value and moat are intact and not likely to be challenged by many other brands. Diageo is the largest alcoholic beverage company in the world. They have a strong balance sheet and they convert over 20% of their revenue into free cash flow. The one area where I see improvement is needed is debt. This company should take some of that free cash flow and reduce their overall debt, even potentially sell stake in one of their least popular brands to get ahead. I believe if and when this company does reduce their debt, it will lead to an even further recovery in the stock, and that should take the stock well beyond their previous all-time highs. The current shareholder yield is 5.6%, which includes stock buybacks and dividends. As of right now, the market has them priced nearly perfect as it pertains to growth opportunities. Any increase in their projected growth should lead to positive movement for the stock. I believe fair value is around $142 per share, which seems to be confirmed by the average analyst target of $145. Next on the list is Getty Realty. That's ticker symbol GTY. These guys are down 15% over the past year, but over that same period, revenue has grown by 13%. Getty Realty has over 1,100 properties spread across 42 states. They lease those properties out to some of the largest convenience, automotive, and retail brands in the United States. Some of those brands include, but are not limited to, 7-Eleven, BP, Shell, Circle K, and Jiffy Lube. Their focus on leasing to well-established brands means investors can depend on their revenue stream for stability. Fitch Ratings affirms that thesis by giving the company an investment grade with a stable outlook. Their dividend has grown every year for the past 10 years, and 99% of their properties are currently occupied. Investors that are looking for value can look forward to an operating yield that's better than 57% of stocks. Getty has also been diversifying their client base, spreading out their risk by leasing to different types of businesses, which offers even more of a margin of safety. In 2017, Their portfolio consisted of 100% convenience store exposure. Today, that number has dropped to 70%, making the company less dependent on a single type of tenant for income. I believe investors are getting a margin of safety at these current prices, with the stock trading 10% below the average analyst target. Getty also offers 6.7% dividend yield, which gives investors an even greater buffer against downside risk. Last on the list is Nike. After Nike's latest earnings report last week, the stock experienced its greatest single-day drop since it debuted on the stock market in 1980. This comes after the company slashed its full-year outlook, giving investors what could be the first real scare about the consumer since 2020. I believe this recent sell-off is giving investors a major opportunity to invest in a globally recognized and respected brand. Year to date, Nike has lost 1/3 of their market value. While that may sound terrifying, what that really means is that investors who buy now are getting a better operating yield than 61% of stocks. This comes just 2 months after Nike snagged the German soccer team contract from Adidas, and as they continue to grow their direct-to-consumer business. If I'm allowed to be honest here, Nike was most certainly overpriced ahead of their earnings. The sportswear brand was priced to deliver double-digit earnings growth for the next 5 years. In reality, analysts have the company projected to give high single-digit growth. So the massive drop in Nike stock does not surprise me. In fact, I believe it's just what the doctor ordered. Nike is currently trading below my average price target of $76.41 per share, and now they're 25% below the average analyst target. I think in the long run, if the economy slows below trend growth, we could see Nike fall below $70 per share. But these current prices are not a bad place to start. Nike also offers a current share buyback program and a growing dividend. If you're like me and you believe this legacy shoe company is going to end up back on their feet, $65 to $75 per share is well beyond fair value. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.